As of Wednesday, May 13th, 2026, at 12:46 p.m. EST, SoFi Technologies Inc. is trading at $16.14 per share, marking a 1.51% increase during the intraday session on relatively steady volume. While the broader market seems to be catching its breath, SoFi stock is showing some quiet resilience after the turbulence we saw following the April earnings report. Most investors expected a continuous upward trajectory after the company proved it could actually be profitable on a GAAP basis, but the reality was a sharp, punishing sell-off that caught many retail traders off guard. The expectation was that record revenue would be enough to ignite a sustained rally, but the reality of a cautious full-year guidance acted like a wet blanket on investor sentiment. The insight here that most people are missing is that this recent price action isn't just about a miss or a beat in the traditional sense. We are watching a massive tug-of-war between institutional algorithms and retail sentiment. On one side, you have the Robinhood app and SoFi Invest users who see the long-term potential of a one-stop-shop financial super app. On the other side, institutions on platforms like Interactive Brokers are meticulously weighing the risk of a slowing personal loan market against the growth in the technology segment. The curiosity loop for today is this: why is the stock trending upward today despite several analysts lowering their price targets just 48 hours ago? It is because the market has finally priced in the worst-case conservative guidance, and we are starting to see the floor established by heavy institutional accumulation at these levels. Common ground suggests that SoFi stock is just a bank in a tech company's clothing. Most people believe that if interest rates stay higher for longer, SoFi's lending business will eventually suffocate under the weight of lower demand. However, the contrarian view, the one that forces a total rethink of the narrative, is that SoFi has successfully pivoted its business model to a point where lending is no longer the sole engine of growth. Their financial services segment and the Galileo technology platform are becoming the primary drivers of high-margin revenue. This shifts the risk profile entirely. If you are looking for investment help or exploring self-investing, you have to look at the technology platform's contribution to the bottom line, which grew significantly this past quarter. Let's look at the movement we've seen over the last few days. The volatility has been intense. We saw a dip toward $15.50 that acted as a psychological and technical magnet, but the bounce back to the $16 range suggests that the bulls aren't ready to give up the ghost just yet. Institutional activity has been fascinating to track. While some big names are trimming their positions in Nvidia stock or Apple stock to lock in gains from the AI-driven tech surge, there is a noticeable rotation into quality fintech names that haven't quite reached their full valuation potential. We see this in the flow of funds within Fidelity Investments and Schwab Intelligent Portfolios, where diversification is pushing more capital into diversified financials. The trading volume today suggests that while the retail frenzy has cooled, the smart wealth is starting to pick up shares on the dips. It is easy to get distracted by the daily noise of online investing, but the reality is that SoFi Technologies is currently navigating a sector-wide reassessment of what a fintech company should actually be worth. For a long time, the market treated these companies like software firms with infinite margins. Then the pendulum swung the other way, and they were treated like stagnant regional banks. The truth lies somewhere in the middle. When you use a SoFi trading platform or look at the Robinhood stock trading interface, you see the user growth in real time. Members increased by 35% year over year, hitting a record 14.7 million. That is not just a number, it's a massive ecosystem of customers who are increasingly using SoFi for everything from their individual brokerage accounts to their mortgages. Speaking of mortgages and lending, we have to talk about the business model. SoFi started as a student loan refinancing company. That was the origin story. But today, they are a vertically integrated financial giant. They own a bank charter, which allows them to use their own deposits to fund loans rather than relying on expensive warehouse lines of credit from other banks. This is a massive competitive advantage. While other fintechs are struggling with high funding costs, SoFi is sitting on billions of dollars in low-cost deposits from their members. This allows them to maintain healthy net interest margins even when the macro environment is challenging. This is why you see so much discussion about them on investing sites and within the Fidelity Mutual Fund's research reports. They are a hybrid that doesn't fit into a neat little box. The expectation was that once the student loan moratorium ended, SoFi would see a massive explosion in revenue. The reality was much more nuanced. While student loan originations did pick up, the company wisely chose to diversify into home loans and personal loans to ensure they weren't overly dependent on one single product. This strategic execution is why they've met the rule of 4 for 18 consecutive quarters. For those unfamiliar with the term, it's a benchmark where your growth rate and profit margin combined should exceed 40%. SoFi is currently smashing that with a score of 72%. That's the kind of data point that professional traders on the Interactive Brokers platform look for, even if the general public is just looking at the grace chart. Comment below how many shares of SoFi you currently hold, or if you are waiting for a deeper dip to 14 before you enter a position. Do you think the current leadership under Anthony Noto is doing enough to convince Wall Street that this is a tech company and not just a bank? I want to see your takes on the community sentiment in the comments section. Looking at the broader macroeconomic pressures, we have to consider the impact of inflation and the Federal Reserve's stance on interest rates. When rates are high, it's a double-edged sword for SoFi.
On one hand, they earn more on the loans they hold. On the other hand, the demand for new loans can drop as consumers get squeezed. However, their acquisition of primary bids suggests they are looking to expand their reach in the capital markets, allowing retail investors to participate in IPOs and follow-on offerings that were previously reserved for the ultra-wealthy. This is a move straight out of the Robinhood app playbook, but with the added stability of a full banking license. The technology segment, specifically Galileo and Technisys, is the hidden gem in the SoFi portfolio. Think of this as the AWS of fintech. They provide the back-end infrastructure for other companies to offer financial products. When you use a digital wallet or a branded credit card from a non-bank company, there's a good chance SoFi's technology is the engine under the hood. This fee-based revenue is predictable, recurring, and carries high margins. This is what separates them from the pack of other invest online apps that are just trying to survive on trading commissions. This technology play is why they are often compared to high-growth tech stocks rather than traditional financial institutions. As we move into the final hours of the trading session, the future outlook for SoFi remains a story of execution versus perception. The catalysts are clear: continued member growth, expansion of the tech platform, and the eventual normalization of the lending market once the Fed begins to cut rates. The risks are equally clear. A potential recession could lead to higher default rates on those personal loans, and increased competition from giants like Fidelity Brokerage or even Apple's expanding financial services could eat into their market share. However, the reality of their Q1 2026 performance, record revenue of $1.1 billion and a net income of $167 million, suggests that the company is more than capable of handling the pressure. The expectation versus reality framing is the only way to truly understand this stock. The expectation is that SoFi will eventually be the Amazon of finance, but the reality is that the road there is paved with regulatory hurdles and intense competition from established players like Fidelity IRAs and the Schwab Intelligent Portfolios. The tension between these 2 points is where the opportunity lies for investors. If the reality continues to show profit growth while the market's expectation remains pessimistic, the valuation gap will eventually have to close. We've seen this play out before with companies like Tesla stock, where the narrative took years to catch up to the operational reality. In summary, the intraday movement today at $16.14 shows a market that is cautiously optimistic but still scarred by recent volatility. We've moved past the initial shock of the earnings guidance and are now looking at the fundamental strength of the business. The core insights today center on the shift from a lending-first model to a tech and services-driven ecosystem. While the general belief was that SoFi was losing steam, the operational data tells a different story, one of record growth and increasing efficiency. As you navigate your own online investing or look for investment help, remember that the most successful players are those who can see through the fog of short-term price action to the underlying value of the platform. The authority of the SoFi brand is growing, and its presence in everything from the Robinhood investments universe to the portfolios of Fidelity Wealth Management is becoming harder to ignore. The company has moved from a disruptor to a legitimate contender in the global financial system. Whether you are using a SoFi robo-advisor or trading manually on the SoFi active investing platform, you are part of a massive shift in how people manage their wealth. The tension between what the market expects and what the company delivers will continue to be the primary driver of volatility, but for those with a long-term view, the depth of the analysis suggests that the floor is becoming much more solid. As the closing bell approaches, watch for any late session surges that might indicate institutional buying. If we can close above the $16.20 level, it would signal a strong technical reversal and set the stage for a test of the $17 resistance level later this week. The narrative is changing, and while the fear is still present in the headlines, the facts are showing up in the financial reports. Stay focused on the data, ignore the buzzwords, and keep a close eye on how this fintech giant continues to redefine the boundaries of what a modern bank can achieve. The current price is just a snapshot in a much longer and more complex story of digital transformation in the financial sector. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends, bell subscribe for more updates.